All right. So what we're taking a look at here is the utility sector, and we're going to pull out all of these companies that we were looking at previously. Um, Go ahead and let's see. Let's put Duke in there. We like Duke. EXC. There was AEP, I believe. Just go through everything. Plains All America, pull them out. SCP, Southern, pull that one out. And what else? I believe that's it. And then Excel, of course. All right, let's double check our work here. Looking at utilities. EXE, SO. We'll pull out PCG too. AEE, because they have the highest average return. Excel. And we're pulling Duke just as a favorite. So let's go back and AEP. It's a shame it didn't keep that. That's okay. We'll just do this again real quick. See, Duke as a favorite. EXC. Plains All American. This is going to be just to have some good comparisons. TD, TU. All right, and Excel. All right. Uh-oh. There we go. All right. So first things first, looking at the dividends, and it looks like Plains All American is the highest, followed by Southern. Then we have Duke. EXE was part of the portfolio that we looked at. AEP showed up twice. So those are the two that were kind of high on the list. I need to double check the portfolio that we're following here, which is the up and standard deviation, and because I want to make sure I stay true to that. And that one for utilities was AEP. So that's what we're looking at here. And let's just do a quick comparison. So first things first, the PE ratio of AEP is 19, Excel is 21, EXC is 21, Southern is way up there at 82. That's crazy. Plains All American is really cheap at 15. I've looked into Plains All American in the past. I don't know what's going on recently. I'll look at the return history on that as well and take a look at it. Let me get rid of this stuff so we're not confused. There we go. So this difference PE is just showing what the PE is now compared to its 5-year average. Okay, that's what that is. And so we see Excel is a bit higher, EXC is a bit higher. We have missing values for these companies here. And that's something that I think I can impute a little later, but for now we'll just have to skip it. Plains All American is way down, and so what that means is that historically, price to earnings has been much higher than what it is now. That's either because the stock price has failed a whole bunch, or that's because earnings has really increased. And just taking a look at a 5-year price chart, I'll kind of move that into the frame so we can take a look at it here. You see, this is 5 years, and it's Plains All American. So it's failed quite a bit over the past year. Over the past year, same thing. It's failed quite a bit. So I can assume that's why the PE ratio has fallen as much as it has. That's not always a bad thing because, like I said, we want to be able to buy stuff cheap, right? All right, let's take a look at net profit. Net profit, as far as I'm concerned, in this particular industry, because it's pretty much all regulated, it's all pretty much the same business, really matters. It's all about management, right? And so what we're looking at is how these companies are managed, and the higher net profit is pretty much the better management. And we see here All American, or American Electric rather, beats out the rest of the field, with Excel Energy coming in a close second. Operating profit, this is literally, again, this is management. This is how much revenue you brought in versus how much it costs to create that revenue. And it looks like Duke and All American, I said All American, why do I keep saying that? Ameren, AEE, are the leaders there. And so this means a couple things. So this means that this company spends the least amount of money to make the most. However, when it comes to their expenses, their payroll, things of that nature, they're obviously really high because their net profit is a lot less than everyone else's. And this also has to do with debt repayments and things of that nature as well. So again, American Electric, top 3, so that's good. Ameren second, Excel comes down, 3rd, 4th place, somewhere around there. Return on assets, these are all about the same. Looks like Duke is a little less. Again, it comes down to management. EXC is even worse, and Ameren. And some of this can have something to do with assets being sold off as well, or sometimes even adding assets. So sometimes there's a backstory in these numbers, but they're all pretty much the same. Cash per share, again, this is how much cash is on the books. Looks like Southern is way ahead of everyone. EXC comes into second place. Everyone else is about the same. American Electric, almost 1%. Excel Energy way down on the list. So American Electric is looking pretty good right now. Cash to debt, this is how much cash versus how much debt is on the books. And you see here, Duke has a whole bunch of debt compared to the amount of cash they have. So that tells me that this net profit is probably having something to do with their debt repayments. And we like companies that don't have a lot of debt, because what that means is with the money that they make, they keep most of it, right? That's what we want, because we want a portion of that cash every 3 months. So American Electric, like I said, comes in, 2nd, 3rd place. EXC is up there, so that's good. This is the percent short. I talked in the earlier video about short interest, and these are the people that are betting against these companies. Looks like Southern is pretty high, Excel is pretty high, Ameren is pretty high, but they're all about the same. EXC doesn't have any, and honestly, when short interest gets really high, a lot of times that means that there's people out there that may know something that no one else knows, right? And they're betting on this thing to fall, and they plan on making a lot of money doing so. But with the numbers so close together, I'm not even going to pay attention to this. I don't think it's going to have much effect at all. Let's take a look at the stocks themselves. This is alpha. This is how well the stock performs when the market is doing really well. And all of these companies are, they're utility companies. So people usually buy these because they want to own something that works well when the market is going down. So, of course, the alphas are not going to be very great for these companies. EXC is the only one that has a decent alpha, or positive alpha, I should say, not really decent. So that says a lot. AEP looks like it's, maybe third, fourth place. It's not a bad deal. Up moves. Plains All American beats out everyone. AEP comes in a close second. So AEP, I'm saying that name quite a bit here, so that's a good thing. See, down moves, and we're looking for the smallest number here. And it looks like Plains All American, and then AEP looks like EXC comes in second. So what this means is EXC performs better rather than a lot of these companies here. But then you look at this up number here, and kind of takes away from this number, right? So 57 is relatively high. I don't know. The average is 58, so it's it's average. Betas. Now this is what I'm looking for in my utility, and we see here Southern, Duke, and Excel do really well, with American Electric coming in a fairly close second. EXE, of course, doesn't have such a great beta because it has positive alpha. This is the average monthly return. These are all about the same. There's not much difference here. 79, 54, 97. Excel, of course, does the best, with Ameren close second. Volatility, with the exception of Plains All American, they're all about the same. I have an average here of about 8%. So, it's a utility stock. They're not going to be very volatile. And then, of course, this is the score. And again, this is scored by, not going to be able to see it right now, but this is scored by up and standard deviation. And Plains All American and American Electric Power score highest. This score is something that I've been working on. It's not completed. There are some missing values, but this is a management score. Okay, and I talked a little bit about management of the company, and right now it looks like the only two positive scores here are American Electric Power and Duke Energy. So I think what we're going to do is we're going to go out of Excel Energy and we're going to pick up American Electric. The thing that gives me a little bit of pause here is that we're in Excel right now at 50. American Electric is 75. So that means that we're going to actually be getting a lot less stock for our money, but the dividend is a little better, and I think it's a little better company. American Electric does some other things other than just electricity distribution. They also take care of some other services for power companies. So that's kind of cool, kind of a diversification, if you will. They also own some rail cars, a lot of coal. The one thing that I don't like about them, I have to say, is that they aren't doing a lot of renewable energy stuff. However, I have to say that Excel Energy has always made me nervous with the fact that they're using tax credits as a way to finance and make the renewable energy investments that they're doing viable. Without those tax credits, it becomes really hard to continue doing that. So American Electric Power doesn't have that issue. They are all about coal and gas and things of that nature. So right now, the way the political climate is going, they are not going to be in a lot of trouble. That can change, though, right? So far, I haven't heard their names come up in any environmental catastrophes or problems or lawsuits or anything like that. I'm sure there are some out there, but nothing, like I said, that's caught my eye. So I think we're okay there. We're going to go ahead and make that change, and I'll be back with telco.